Hello friends, welcome back to my channel. Today we will be doing capital budgeting techniques. Capital budgeting techniques are the techniques which helps a firm in evaluating various proposals and selecting the best fund. These techniques are classified into two groups, that is the traditional or non-discounting technique and the second is discounting technique. Traditional technique. Traditional technique do not discount the cash flow to find out their present worth, and there are two types of traditional technique, that is payback period and accounting rate of return. Discounting techniques, these are the techniques in which the cash flows are discounted at appropriate rate of interest to find out their present value. There are three types of discounting technique: net present value, profitability index, and internal rate of return. Let's begin with payback period. It refers to the period in which the project will generate the required cash inflows from an investment to recover the original cash outflow or initial investment. In simple terms, it helps us to find out the numbers of years which are required to recover the original cash outlay, or it helps to determine the length of time required to recover the initial cash outlay in the project. There are two methods of calculating the payback period. The first is when cash inflows are equal. So the formula for this is initial outflow upon annual inflow. Let's understand it with the help of an example. A project requires an outlay of rupees 1 lakh. This is your initial investment that the firm has made and is expected to generate cash inflows of rupees 20,000 per annum for 6 years. It means that the firm is receiving rupees 20,000 per annum for the 6 years. So the cash inflows are equal. So using the above formula, payback period can be calculated by using the above formula, that is initial outflow upon annual inflow. Now, initial outflow is rupees 1 lakh and annual inflow is 20,000. So payback period is 5 years. This means the firm will be recovering this amount in 5 years. The second method of calculating the payback period is when the annual cash inflows are unequal. So let's solve a question based on it. ABC Limited is planning to start a project which require an initial outlay of rupees 1 lakh for the purchase of a machine having of 5 years. It is expected to generate year-ending profit before depreciation and taxes of rupees 50,000, 30,000, 20,000, 30,000 and 40,000 from the end of the first year to the end of the 5th year. Assuming that the company pays income tax at the rate of 40% and uses straight line method of depreciation with no salvage, compute payback period. So to solve this question, we have to first find out the cash flow. So to find out the cash flows, first what we have to do is we have to deduct depreciation from the profit. Then we are left with profit before tax. Then again we have to deduct tax. We are left with profit after tax. Then we have to add depreciation again to find out the cash flow. So using the format, first here we will write year, that is 1 to 5. 1, 2, 3, 4, 5. Second is of profit. It is profit before depreciation and tax. 50,000 for the first year, 30,000 for the second year, 20,000 for the third, 30,000 for the fourth, and for the fifth it is 40,000. Now we have to deduct depreciation from it. To calculate the depreciation, we have to divide the initial outlay by the number of years, that is 1 lakh divided by 5. So depreciation is rupees 20,000 for each year. Now profit before tax will be profit minus depreciation. So 50,000 minus 20,000 is 30,000. 30,000 minus 20,000, 10,000. Here it will be 0, 10,000 and 20,000. Now we have to deduct tax from it. it is given as 40%. So 40% of 30 is 12,000. 40% of 10,000, 4,000, 0, 4,000 and 8,000. Now after deducting the tax from profit before tax, we will get profit after tax. So 30,000 minus 12,000 will be 18,000, 6,000, 0, 6,000 and 12,000. Adding depreciation back to it, we will get cash flow. So depreciation was 20,000 for all the 5 years. Cash flow will be 38,000 for the first year, 26,000 for the second, 20,000 for the third, 26 fourth year and 32,000 for the fifth year. Now since we have to calculate the payback period, we have to make an extra column of cumulative cash flow. So the amount of the first year for cumulative cash inflow will be same as that of cash flow. Now for the second year, we will get the amount by adding rupees 20,000, 26,000 to 38,000. So 26,000 plus 38,000, it is 64,000 for the second year. Then again adding the 20,000 to 64, we will get 84,000 for the third year. Again adding, will get 1,10,000 for the fourth, and last it will be 1,42,000. Now we can see that the required cash inflow is rupees 1 lakh. Since the initial outlay is 1 lakh, the required cash inflow is also rupees 1 lakh. Now till the end of third year, we have recovered an amount of 84,000. We have to recover an amount of 1,00,000. So the remaining amount is 16,000. But at the end of the fourth year, the cash inflow is of rupees 26,000. But we just require 16,000. That is the difference of the cash outflow and the cumulative cash inflow at the end of the third year. So to find out the time period required to earn the cash inflow of 16,000 during fourth year, we can calculate this amount by dividing 16,000 by 26,000. That is the cash flow of the fourth year. This is the time period for the fourth year, and we have already taken 3 years to recover an amount of 84,000. So the payback period will be 3 years, the time taken to recover 84,000 rupees, and 0.61 years for recovering 16,000 rupees. So the answer will be 3.61 years.